Just to recap, a private equity fund is formed through a limited partnership between the limited partners, the investors, and the general partner, the private equity firm. Now, the private equity fund is usually 10 years in length because the private equity firm needs to find companies to buy, needs to buy those companies, which takes a lot of due diligence and negotiation, needs to create value in the companies, and needs to sell those companies. Now, what happens if in a 10-year fund, the private equity firm still has a company or multiple companies that it has yet to sell? Well, ideally, it would be able to sell it to a strategic buyer, financial buyer, or bring it public on the market with the IPO. But recently, because of high rates and a softening private equity market, it's been more difficult to find those buyers or those exit options. And so the private equity firm has the option to sell the company or companies to itself in something called a continuation fund. Now, a continuation fund, also referred to as a continuation vehicle, is a special purpose vehicle that is formed by the private equity firm to sell a company or companies to itself. Now, if it sells one company, it's called a single asset continuation fund. If there's more than one company, it's called a multi-asset continuation fund. Now, here's how it works. The private equity firm will go to its existing limited partners and give them the option, if they would like to buy into the continuation fund, to continue holding that company or companies. Usually, some of the limited partners will say yes, and some of the limited partners will say no. Now, if some limited partners say no, the private equity firm will find other investors to invest in the continuation fund and become limited partners of that continuation fund. Now, this sale will provide an exit for the private equity firm. Now, just because it provides an exit doesn't mean that the private equity firm can actually take the performance fees. What usually happens is the private equity firm will roll over their performance fees to be invested in the continuation fund. That being said, one could argue there's a little bit of a conflict of interest here because when the private equity firm sells the company or companies to itself, it crystallizes its IRR. In other words, it's counted as a sale for the private equity fund. The private equity fund will have an IRR based on this sale, and private equity firm will be able to use the track record from this IRR in future fundraising. So what are the pros of investing in a continuation fund, and what are the cons of investing in a continuation fund? Well, let's start with the pros. A continuation fund is just a subset of a private equity secondary investment. Now, there's two types of private equity secondaries, an LP-led and a GP-led type of secondary. A continuation fund is just a subset of GP-led secondaries. Now, if you want a refresher on what that means, please check out our video titled LP-led secondaries versus GP-led secondaries. Now, one of the advantages of investing in a continuation fund is that it mitigates blind pool risk. Blind pool risk is the risk that exists in traditional private equity funds, where a private equity firm raises money from the limited partners before it actually buys the portfolio companies for the private equity fund. Because the companies don't already exist in the fund when the money is raised, we say that the LPs are blind to which companies there are in the fund because they don't exist yet. And we say that is blind pool risk. In a continuation fund, the company or companies already have been purchased and exist, so the limited partners can do diligence on those companies, and so blind pool risk is mitigated. Another advantage to investing in a continuation fund is that it has a shorter duration than a traditional private equity fund because the private equity firm doesn't need to find and buy the company. It just needs to finish creating value and exit that company. Now, there are cons associated with continuation funds as well. The first con is the price that is paid for the company or companies. It's a little interesting that the private equity fund is selling to itself. And when it sells the company or companies to itself, it gets to use the exit price to crystallize the IRR of the first private equity fund. And so the private equity firm may be incentivized to sell at a higher price than maybe it should. So that could be a con. Another con is the fact that the private equity fund might not be actually selling its top company or companies to itself. And the LP might end up holding a company in the continuation fund that might not be successful. Let me give you two examples. A company called Wheel Pros, which designs, markets, and distributes aftermarket wheels, was in a private equity fund owned by Clearlake, sold to a continuation fund also operated by Clearlake, and then the company went bankrupt. Another example is Enviva. Enviva is a wood pellet company that was owned by the private equity fund operated by Riverstone, sold to a continuation fund also operated by Riverstone, and then it went bankrupt while in the continuation fund. So investors, how do you invest in continuation funds? Well, you can do so in secondaries funds that invest in all types of secondaries, such as HarborVest or Northleaf. You can invest in secondaries funds that have dedicated vehicles just for continuation funds, such as ICG or Altex. Or if you have the connections in deal flow, you can invest in continuation funds directly. But regardless of how you invest in continuation funds, the question is, should you invest in continuation funds? Well, it all depends on how it fits into your portfolio, and because of the fact that you have access to the companies or company that is getting sold, you have the opportunity to conduct detailed due diligence to make that decision.